Well, it's my pleasure now to introduce the moderator of this very distinguished and insight-giving panel, Nick Timiraos. Have I said that correctly, Nick? He covers this very question for the Wall Street Journal and has for a number of years. But he didn't start on housing finance. He took on an easier subject, the presidential campaign of 2008, where he covered both the Obama and the Clinton campaigns. So we may get a little political perspective today as well. He also has a blog. I urge you all to take a look at it. And if you want to follow housing finance, why, just keep reading his columns. And he will, I'm sure, bring us the very best news just in the nick of time. Nick, the floor is yours.
Thanks so much. I don't know if it's always the best news, but it's bad news presented well, I hope. So thank you for having me, joining me this morning for this first panel. This subject is how did the mortgage finance pipes become clogged? Immediately to my left, Carrie Vandell, who's the Dean's Professor of Finance at the University of California, Irvine. Josh Rosner, Managing Director of Graham Fisher and Company. And John Worth, who's the Chief Economist at the National Credit Union Administration and who's previously the Director of the Office of Microeconomic Analysis at the Department of the Treasury. So to start us off this morning, and one reason why I'm always convincing my editors that we should be able to write a little bit more retrospectively about what happened. Josh, of course, you wrote a whole book about this, but I think the question is important when we look to where we're going, because how you conclude, how you view the collapse really informs your view, of course, of what we should do going forward. And so I guess I'll start off, and maybe again we can carry on down. If you had to define the main culprit or culprits, the main villain or villains that contributed to the collapse, what would those be?
We only have an hour. Let me just mention, Josh has written a book. I've been spending my time the last 3 or 4 years or so more with attorneys than with my colleagues as an expert witness in a number of the cases that have related to financial institutions and some of the problems. And my assignment, part of my assignment there, is to really try to dig into what we financial economists call the market microstructure of the collapse, and the problems that really created that. So I've had access to a lot of information that's related to these cases. It's given me, I think, a much clearer insight into what's going on. Unfortunately, that clearer insight is not a simple answer. As we all know, there are a number of players in this entire process over time. There are a number of contributing factors that resulted in the circumstances we faced in 2005, 6, 7 that really led to the collapse. Many of what might have been called the villains were really well-meaning public agencies, well-meaning interest groups, and others who advocated, and I think rightly so, for the expansion of credit opportunities among those classes of households that really were shut out of the traditional residential finance market. Both the Clinton and Bush administrations had very aggressive policies to encourage the increase in home ownership through various means, whether it be by reducing down payment or the encouragement of expanded underwriting standards, the encouragement of development of a private label security market. They all played a very active role in that. Now, there's no doubt that one would have mixed motives in that. Not only were they encouraging home ownership, Crisis Inquiry Commission and of the work that I've seen, Freddie and Fannie did not precipitate all of this. They've been around for a long period of time. And it's true that there were very political involvement of Freddie and Fannie over the last decade and actually before, in terms of lobbying, in terms of their expanded roles. But I think one can put another cast on that that relates more to the fact that they were not the 1,000-pound gorilla that was dictating everything that was done by virtue of their political power. There was also a countervailing force that was represented by the long time, especially after the deregulation of the banks, resentment by the banks, it's very clear, of their implicit, now explicit federal government guarantee on their debt, their lower cost of capital and other advantages that they held, and the fact that there was a lot of evolving business out there that they did not have a chance to get. So we had FM Watch, we had many hearings relating to capital standards, and let's be very frank about it, the earlier issues really did not have to do with credit risk or default risk. It had to do with prepayment risk. The pressures on Freddie and Fannie increasing affordable housing goals and taking a greater role in the broadening of credit to broader household classes. And ultimately, in the encouragement, in fact, the forcing by FHFA of Freddie and Fannie to purchase Alt-A, subprime, and other private label securities. The scandals, I can't leave out the accounting problems and the resignation of both CEOs. There was a lot of political pressure being brought to bear. And very frankly, those of you who were involved in much of this know that the exact objective was to diminish, if not eliminate, the presence of the GSEs, or at the very least eliminate the federal guarantee. But in reality, what the real factor was that created all of this in the end was the failure or the inability to properly price these securities and to price the credit risk that was embedded within them. And that had to do with the fact, and we were able to get into this with a number of institutions, both monoline insurers, private mortgage insurers, rating agencies, and others. The models used to price this risk, first, they were not very sophisticated as one would expect. For institutions that are supposedly large institutional investors or other players in the market, they were oftentimes simple stress tests. They were adopting what had been used as parameters for pricing models for traditional fixed rate, fully amortizable mortgages. They were adopting those to exotic instruments that were very, very different, that had no sort of real relevance in terms of the way these models were being used. And finally, and the most important thing is, they virtually never undertook any sort of stress test that anticipated a 40% decline in house prices over a 2-year period. And systematically across the government. It just didn't occur. We found in one case where an institution did do that in their pricing model just for the hell of it, to see what would happen. They actually got a result in terms of defaults that modeled very closely what actually went on. That ultimately was the problem. And you say, well, surely someone knew. There was someone who knew out there. But if you look at the rating agencies, if you look at every one of the players, they didn't incorporate any of that in their models. Now, there were people who knew, or they thought they knew. Bob Schiller thought he knew. He announced it.
Some of us did know.
Well, he knew, and he announced it. John Paulson knew, or he thought he knew, but you didn't really know.
Oh, in 01, I actually wrote the paper.
So Josh, so what would you identify as the culprits?
We could take it from 10,000 feet on down. First of all, I would say that the word expand opportunities for credit is a misnomer. and it whether well-intentioned or a game, really should be called the opportunity for populations who might not be able to manage the debt to become indebted. Okay? Other than appreciation, we sucked a lot of people into home ownership that ultimately, without the appreciation, really couldn't afford the home on the mortgage products.
Hadn't FHA been doing,
So let's go back and beyond that, okay? And the answer is yes, but that was with plain vanilla mortgage products, 30-year fixed rate mortgage product. But let's go to the other levels. To me, the big problem, the 10,000-foot problem, is the distortion of the term home ownership and the continued application of it to a very different thing than what we'd seen historically. Historically, since the Depression, for the most part, people at about the time of household formation took out a 30-year fixed-rate mortgage. It was a relatively illiquid asset, which is the reason housing has had the social place that it has in our society. You made monthly payments of principal and interest, so that at about the time of retirement, you were able to have a mortgage burning party, and you retired with what had become the single largest retirement and intergenerational wealth transfer assets for most American families. In this cycle, we distorted that, and we failed to recognize that until you own your home, you're a journeyman on the way towards home ownership. But while you have a mortgage, you are not a homeowner. Okay? And so what we did was we distorted by allowing the creation of liquidity products, the lowering of barriers. And so back in summer of '01, we were facing the residue impact of the dot-com bubble, and clients were coming to me and saying, housing typically lags by 12 to 18 months, or we're going to see a housing recession. And I wrote a big paper. It was called Housing in the New Millennium, A Home Without Equity is Just a Rental with Debt. And in that, we went through the structural changes that were being missed by most housing economists. Okay? The drastic reduction of minimum down payment levels, the focused effort to target low-income borrowers, the reduction in private mortgage insurance requirements on high LTV mortgages, the increased use of software to streamline origination and modify and recast delinquent loans, the change in the appraisal process, which has led to widespread over-appraisal, over-valuation problems. And in that warned that if these trends remain in place, housing will outperform GDP by leaps and bounds until such time as interest rates rise, unemployment rises, or wages fall. Well, in the end of '04, it was clear as the Fed started hiking rates that the peak was close at hand. And what we were watching was the private label market, which people want to say was the culprit, had really emerged. At the time that I wrote that '01 paper, there really was no private label market. We had what I call subprime 1.0, but that disappeared because of gain on sale accounting in 1998, and it really was a very small and isolated market. Mostly subprime in its first public market iteration were mortgage originators who did require higher rates or higher down payments, okay? And they did price for risk, and it wasn't the same products by any stretch. If you look, we created incentives to increase home ownership to a population who might not have been ready, prepared, and certainly were not intending, or policy wasn't intending, for them to be homeowners in the traditional sense. In other words, housing is a forced savings plan. Okay? Instead, it became a piggy bank. And so the initial push was we took home ownership levels to record levels. Historically, since World War II, they had been between 62 and 64.5%. And at the time that the Clinton administration created the National Home Ownership Strategy and the National Partners in Home Ownership, which was the largest public-private partnership that we'd ever seen in this country, for the sole purpose of increasing home ownership to record levels by the end of the millennium, without asking what are the benefits, what are the risks, and what do those terms mean, okay? We created the roots of the crisis. Now, it's important to remember home ownership levels in this country peaked at the end of 2004, okay? So that wasn't even the bubble period, or it was, but we didn't consider it. And they peaked at 69.2%, Okay? So we distorted and drove that 62 to 64.5% ownership rate up to 69.2, and it peaked, but that was in '04. So what happened after that? We're still not recognizing that '04, end of '04, '05, '06, '07 were about increased refinancing activity, mostly with cash out, piggy bank effect, and that almost 40% of all home sales in those ensuing years were for second homes and investment properties. In other words, speculation. We overshot the mandate of increasing home ownership and created distortions by which liquidity product, and the Fed had a big piece of this by holding rates as low as they did, as long as they did, distorted what had already been a distorted definition of home ownership. Okay? Now, to me, let's then go to the GSEs very quickly. What should the GSEs have been? We can sit here and we can talk about, well, it was well-intentioned, oh, it was, good policy, bad policy, villains, not villains. To my mind, it's irrelevant. I don't have any ideological dislike for a utility that is intended to provide liquidity to the secondary mortgage market when liquidity is withdrawn. But the GSEs didn't do that. That was their primary mandate. Okay? And instead what they did is they were pro-cyclical. They added too much liquidity, okay, creating this race to zero. And when the private market failed, and the GSEs therefore should have been ready, prepared, and well enough capitalized to step in and provide that secondary mortgage market liquidity, they were undercapitalized. And so in thinking through what we're seeking to do going forward, I think the first goal should be to recognize that a counter-cyclical utility that is able to provide liquidity to the secondary mortgage market when the private market fails may or may not be a noble goal, but that's not what the GSEs were as we knew them.
So John, I mean, we've covered a lot, but anything that you think we've missed?
So, let me agree with Josh that I do think that's the principal failure of the GSEs, is that we made this sort of deal with the devil for years, and then at the time we were supposed to get the payoff, our insurer fails. And that is a key lesson coming out of the crisis. I think the other thing is just to build on what you guys have had to say for a second, is that I think the reason the investors were there to support this new version of home ownership, it's important to think about why they were willing to participate in this. And my view is that a number of institutions felt like they had effectively de-risked themselves of inherently risky assets. And that's why they were willing to participate on the other side, both because of views on home appreciation, through modeling assumptions and pricing models and maybe a lack of stress testing, as well as some of the mechanics of the originate to distribute model, and what was viewed at the time as cheap protection through credit default markets and through mortgage insurers, who again we're gonna pay off in times of crisis. So I think it's important to remember that side, that this was driven by a demand for these assets that, in my view, was underpinned by unfortunate assumptions about the riskiness of these assets. So I think that kind of brings those two sides together.
A possible rejoinder?
Yeah.
Sure, please. A couple of points here. First, I mean, there are many things I agree with Josh about and John, especially in terms of the inability of the GSEs to actually step in the appropriate way. But I think we have to remember, in part, that the undercapitalization had to do with a run on the bank during a very critical time that was occurring throughout the economy. I also hold it. Let me also the critical period here was when underwriting standards and pricing really departed from underlying economic fundamentals, and that didn't happen as early as the 90s or even 2001. It happened from the research that we've done and others have done. Bill Wheaton at MIT found that in late 2003, as rates were increasing, as Freddie and Fannie essentially were pushed out of the market because their pricing models didn't permit them to really continue as actively, I understand from the folks there. And that's the time at which the market really became heavily dominated in a very short period of time by the private label issues, the exotic instruments that really took over. And it was at that time where there's very clear evidence statistically that there was a divergence between what was going on in the mortgage market at that time and underlying macroeconomic fundamentals in the economy. So I think we need to look in particular at that period of time to where the problems are. Freddie and Fannie ended up stepping in, albeit as now under conservatorship, but thank God at least they were there during that period of time.
So would it be fair?
Can I respond to that?
I will let you. But so would it be fair to say, because the GSEs had experimented with some, changing DTIs, loosening the dial a little bit, and then would it be fair to say the private sector, whether it was Bear Stearns or whoever came in and just completely turned the dials up in 2003?
Actually, it was end of 2001 that they turned up the dials. We didn't feel it in the market until 2003. And by the way, in February of 2007, I presented a paper at Hudson Institute warning that the MBS market was coming apart at the seams and would fail because of a lack of bid for CDOs, which was the last repository of mezz tranches, and that would bring down the housing economy. So we're not in total disagreement here. The GSEs were buyers of 25% of all the PLS, and that's important to remember. Hold on, let me finish. Okay, but rather than this become a GSE's right, GSE's wrong, let's talk about it a little bit more, I think holistically, which is the GSEs, to their credit, created standards. Okay, standard underwriting, standard pooling and servicing agreements, standard reps and warrants, standard structures. Okay, and in 2001 we saw the banks and investment banks say, hey, why should a similarly rated agency security have a different capital risk weighting than a private label security that's got the same rating? And they won that. And once that happened, yes, the private market was off to the races. All of a sudden we saw the banks that had origination channels, i.e. branches, started to focus more on consumer. And in fact, many of these banks had told us only 5 years earlier that they were getting out of the consumer lines and really going to focus on commercial. Okay? And that's important to remember. The investment banks said, wow, this is a great opportunity, and they started creating warehouse lines to third-party originators. The third-party originators started delivering in product to them. And ultimately, as the demand and the product was flowing and MBS investors were searching for yield in a low-yield environment and bidding for these securities, we ended up seeing the power shift from the underwriting standards that those investment banks demanded of the third-party originators to the third-party originators saying, forget your underwriting standards, take this or don't take this because we've got other investment banks that'll take it. And that drove us down. Now, the problem there was that there was no ability of institutional investors to do the analysis on collateral before a deal came to market. Okay? And that's a key lesson that we still haven't addressed. The SEC has now had a draft Reg FD extension for 2 years. Okay? And it's actually a pretty good product, but we haven't seen it come out. That would have allowed investors to say, we're not going to rely on the rating agencies. A pool has to be completed before it's sold to investors, and the investors should have a cooling off period, just like they do in the equity markets with the red herring, to do analysis, loan level analysis of the underlying collateral. Okay? And the banks and investment banks, you're right, it's not just the GSEs, the banks and investment banks have done everything they could and continue to make sure that investors do not have adequate levels of transparency to close that arbitrage. So I'm not taking an ideological stance. I appreciate it sounds like you're taking one just to defend the GSEs. But I come here. Well, but that's kind of the position that we're playing.
So John, why did private mortgage? I mean, Josh kind of sketches out the first few innings. Why did private mortgage finance freeze up so fast and so completely in 2007?
So I'll be interested in what everyone has to say, but I link a lot of the speed of the freeze and the drop off was almost complete and seemed in some ways almost instantaneous to to what I was talking about earlier, that there were, when the assumptions about the riskiness of the assets were revealed to be incorrect either through any of the channels, that really the sort of, the sand on which the infrastructure was built really just disappeared. And so those assumptions changed, the underlying views of the riskiness changed, and the underlying views of the ability for whoever you had gotten on the hook to insure the asset and their ability to come through as a counterparty changed, then the whole infrastructure goes away very, very quickly. And so I really attribute it to that the much of the PLS market that built up in that 04, 05, 06 period when it was growing very, very rapidly was really built on a series of sort of cascading faulty assumptions.
Which, if I could just expand upon that, I agree and would say it goes back to that transparency. So if you recognize that institutional investors didn't have, at time of origination, the ability to have a look through, but they also had 300 different pooling and servicing agreements and rep and warrant agreements. And in the good time, they were just bidding. Okay? As soon as they started seeing the early payment defaults rise in the late 06 and 07 vintage, the investment banks started shutting down the warehouse lines to these firms. Investors stopped in their willingness to buy the CDOs, which were the repositories of the MBS, and they started to flee. And they said, you know what? We've got 300 different pooling and servicing agreements and rep and warrant agreements in front of us, and I don't know what my rights are under each of those, and I don't have time to sit down and read 300-page documents to figure out what they are on each deal. So I'm getting out, and I'll sift through the rubble later. And we saw that all occur almost overnight. That's what my February 07 paper and then misapplication of ratings paper in the spring of 07 warned. I think we've misdated the crisis. The crisis was most clearly kicked off by the fact that the investment banks shut warehouse lines and bankrupted more than 70 warehouse lenders by March of 2007. And that became a trigger event which created concerns. That was driven by early payment defaults, which drove concerns or exacerbated concerns of institutional investors to recognize they didn't know what their rights were to the assets that they owned, and they weren't even sure really what the underlying features of those assets were because the early payment defaults were rising so rapidly.
So, Kerry, I have a question for you. I mean, it was obvious, I think, to a lot of people in 2005, 2006 that the products being made were just not very good products. You have these NAGAM loans with zero down, all these layering of risks. Why did we end up with so many really just terrible products?
Actually, the expectations were not reflected in the market. If you look at the marginal investor, the investor at the margin during that period of time, those were still not being incorporated in 2005, 2006. S&P downgraded a few issues, which was not much more than the issues that they had downgraded throughout the 2000s. It wasn't until, if you look at the house price indices, whether it be OFEO or Case-Shiller, they were very ambiguous during this period of time, 2005, 6, on into the latter part of 2007. And if you look at the surveys that were done by the mortgage bankers associations and the Fed did of senior loan officers, you see a rolling sort of set of expectations going forward as to what was going to happen to house prices and whether there would be a significant decline or whether there'd be, as they called it, soft landing. And essentially the soft landing persisted, especially in the Fed survey until late 2007 on into 2008. So those expectations weren't really there. Yet at the same time, we started seeing defaults increase back in 2007. We had signs, and in December 2007, unemployment was increasing during 2007, and I think the formal beginning of the recession was December 2007, as I remember. So there were signs going on then. But when all of this was recognized, and this was also the time when the ABX index, when market had produced the ABX index, so we had the first sort of external evidence of price, of pricing of these issues out in the marketplace. That created a whole cascade of recognition during that period of time. That's not to say that the issues that Josh and John have not mentioned were not reflective of that. But in the primary market as well as the secondary market, the spreads increased considerably. The withdrawal of lending, the underwriting standards were pulled in considerably during that period of time, and it all happened within a few month period.
It's also important, just as a one sentence, because I think Main Street and much of the press really forgets that price and value are two very, very different concepts. And that's a big piece of this crisis. And so we looked to pricing models as though they were reflective of value. Okay? And I think that was another piece of the failure that needs to be considered.
John, why do you think, why would a banker have made some of these loans that just on paper, absent, as Josh said, price appreciation, looked completely unsustainable? Why did these underwriting standards just deteriorate again and again and again?
Well, I mean, these loans got made because they worked under the set of assumptions under which they were modeled, right? I mean, price appreciation, looking back, obviously, and to some people at the time seemed unsustainable. But as long as you weren't the last guy holding the bag, you were fine. And if you look at the forecasts at the time, it was either continued appreciation or soft landing. Well into 2007, that was the consensus forecast, and so that's what's going to drive a lot of the modeling. And if you get appreciation or even sort of a relatively soft landing, you can get out of a lot of these assets and make a profit. And you're not going to have this incredible slowdown in prepayment speeds or this drive up in delinquencies that ended up sort of crushing the market. So it's really, it comes back to this view of fully understanding or misunderstanding the risks that are inherent in the assets.
And you got to remember that the Fed began to tighten dramatically, 25 basis points a quarter, okay? And that really wasn't appreciated in the forecasts, nor was the understanding of how far they would go and where that tightening would end. And I think you have to also remember that human beings are at core, at soul, behaviorally optimistic. And there can't be explanations for manias. But that really is what this was.
And we were also running out of clients. I mean, basically the notion had been that we have this infinite supply of home purchasers out there. And in fact, there was a deterioration in the quality of the credit queue. And that became very clear. That was about the same time that the underwriting standards were widened considerably after the 2003 period.
They were widened considerably, though, in the late 90s, which is how we got from 62, 64% historic home ownership levels. That was equilibrium. It still is equilibrium, by the way. That's the natural level of home ownership in this country, okay, on a fundamental sustainable basis. We got it to 69.5%. By changing, by increasing, by moving to streamlined underwriting, by moving to automated valuation models. We really drove that expansion beyond where it should have been, and we're suffering for it. We're going back. Now, by the way, we're going back in a period which I think is important to think about going forward, where the household formation is only growing in the 54 and over age cohorts. Well, home ownership rates in those cohorts are already about 70%, 80% in some of those quintiles, where the under 29 age cohorts, household formation is shrinking, but also there's a different behavioral relationship with home ownership. Okay, it's now a utility. They've learned that housing prices don't always go up. Okay, and oh, by the way, they're saddled with $1 trillion of student debt, and so we're going to see a very different relationship going forward in younger populations and home ownership than we have. I think that's important to think about.
You touched on this in your opening remarks. Did we promote home ownership too much, or was it these kind of exogenous, the cash out refi, the speculative purchases? If you take those away, did we have 2005, 2006?
But we're not willing to take them away. Just take a look at the battles that are going on the qualified residential mortgage rule, where 20% down sounds outrageous. That was your grandparents' mortgage product. Okay?
Well, except for the FHA, VA.
Of course, but with those you had some sort of and obligation that was associated with getting those products. And that's an important point that you bring up, which is those products, those subsidies which were defined for social benefits, first-time home buyers, military coming back, those were on-balance sheet government subsidies. If we're going to have the government involved in mortgage finance and mortgage origination by way of subsidies, it should be clear, explicit, transparent, and on balance sheet. And the private markets should not be used as the mechanism to transfer those subsidies either to investors nor to borrowers. But I think it's really important to think about sustainability of debt. And I don't think we increased home ownership. I don't think we gave access to credit. I think we indebted a group of populations without thinking about their ability to manage, and I'm talking about financially, that debt. And even in the way we're looking at now things like risk retention, okay? We're forgetting that the notion of aligned incentives on things like risk retention ignores the fact that most of the institutions that ended up in trouble because of the retention of risk.
Right, Bear Stearns. Well, you could argue Bear Stearns wasn't able to sell the stuff at, once the market turned.
Right. But it was the transparency that's the missing feature, and we haven't even begun to address that. And I don't think anyone, I don't think anyone intended to create this crisis, harm their neighbors, etc. I think that was largely mismodeling, optimism, but it was really about the lack of transparency, the lack of ability to really do analysis. And so even as we started thinking about expanding home ownership, we forgot home ownership empirically, the data, was based upon 30-year fixed rate conforming conventional mortgages historically. Okay? And as we moved out and introduced new products, we still used the same terms and we still relied on empirical data to a whole series of products, populations, okay, and environments to which they'd never been tested.
John?
Let me just, a couple thoughts on households, since we got on, who generally sort of escape blame when we talk about culprits, but clearly, households bought in fully to the idea that home ownership was a quick way to create wealth. And, sort of, I just hope if you don't sort of believe this, just do a little Google search about how many TV shows came on between 2003 and 2006 with the title "flipping" in them. It's like 5. You couldn't flip around cable TV without seeing people flipping houses for profit.
Wasn't there a fear that if you didn't, in Southern California, the worry was if you didn't buy now, you were never going to be able to own because prices would...
Yes. But also remember that, to support your point, just remember 2004 to 2007, between 36 and 39% of home sales were second homes and investment properties, which is precisely your point.
You saw lots of people jumping into second homes and second properties, and you had lots of people. I was talking to a group recently, and I put up a quote from my realtor in 2004, which was, "Well, you better buy a lot more house because you're going to make a lot more money." And everybody said, "Oh yeah, I heard that too," right? So there was a full buy-in in households that this was a good idea, and it really entered the bloodstream. But going forward, I think Josh hit on an interesting point, which is that one of the things we really need to see is whether coming out of the financial crisis, one of the lessons that households learn, especially younger households, is a reordering of the priorities of their debt, and whether we don't see this phenomena of higher mortgage delinquency rates than higher auto and credit cards becoming a permanent phenomena. It's something that in the credit union sector, which I study now, we see right now, and it's the first time really in the history of the sector we've ever had that. And it's a complete flipping of what we've seen in the past.
But they'll buy Facebook. Sorry.
So Kerry, with respect back to the GSEs then, did they provide too much liquidity? If they stumbled, obviously they did, what was their mistake?
I actually don't believe that they were responsible for liquidity. Much of their problem did not have to do, it's certainly true that their conventional conforming pools had higher default rates that had been anticipated. But many of their losses related to the private label securities that they had bought during that period of time, especially Alt-A and a few of the subprime. I mean, that was where the problem really lay. Now, if that's increasing liquidity, and it's doing so indirectly by buying the private label securities, that was not something that would have been their preference, although they had to admit, my friends at Freddie and Fannie tell me, we would have done it anyway, even if it hadn't potentially counted. And I've gotten mixed signals as to whether
The goals maybe gave them cover. for
whether
doing
that's correct, but they were very profitable, or thought to be very profitable at the time.
There's still the 2007, 2006 vintages for Fannie and their guarantee business. I mean, you're talking about double-digit default rates. So was the problem that they just didn't hold enough capital for that level of default?
Yeah, I mean, their mix got increasingly bad over that 2004, 2005, 2006 period, and their capital standards were obviously
That's right.
inadequate.
That's the critical period.
Wholly inadequate, even for
Especially with the run on the bank.
Well, I mean,
and
I
the
think
decline in the value of their equity.
that's the sad truth of the entire crisis, not just for the enterprises, but for the banks.
Right.
Capital, capital, capital.
But I think when we talk about the model, you know, it's useful to compare the GSEs to FHA, which at this point was not changing its standards, was not chasing business, had a market share down to like 3%, and everybody's wondering what are we going to do with all these guys in the beautiful HUD building.
There were bills in Congress to let FHA
right.
do 0%
Right.
down because they thought we're not getting enough business.
And in some sense, that's what you'd like out of a utility model.
That's right.
For the organization to essentially go dormant while maybe the market is a little bit out of balance, but to be there, well capitalized and ready to do business when you have a crisis.
And now that you've got
FHA has been there before. If you remember back in the 90s, they were being pushed out of the market, and the response was to increase their loan limits to try to create cross-subsidization with the lower income households. Now their loan limits are higher than Freddie and Fannie's, right? I mean, that's the whole idea. They moved in, and
Right.
you had
Talking about
mentioned
back
that
then.
the subsidies associated with FHA. I don't think many FHA borrowers think of themselves as being subsidized homeowners. I really don't think their incentives are different in terms of saying, I have an obligation to repay, whereas the conventional conforming types of loans do not.
I don't really agree, and we can go through that, but I think the broader point is exactly right, which is that a utility is supposed to be there. You know, Verizon, or I should say Ma Bell, had to have 99.99% redundancy so that it didn't fail. Con Ed, we don't ever expect our electric provider to fail. Okay? A utility is supposed to be there and stable and, in the equivalent, well enough capitalized or redundant to make sure there's no failure. FHA, I think it's right, was in a place where it was losing business, and that should have been fine. Now we've got an environment where you've got a strong regulator at FUFA, at FHFA, who is tightened the underwriting standards, and now you've got FHA adversely selected. Okay? So all the volume is going there, and they're now the reckless gorilla and the only participant in the market, I should say.
So, Josh, how much blame then? I mean, Kerry touched early on about the goals. The housing goals there's a huge political debate around this, but Fannie and Freddie's problems were really concentrated into Alt-A, right? They bought a lot of Alt-A.
Right.
Liar's loans. I mean, are you getting income credit for loans where people are not being honest, perhaps, about their income? How much blame do you assign to the goals?
I assign blame to the goals because the goals gave political cover to intertwine a social mission versus a financial player, right? So I actually won't overstate the goals. I do think, though, that it was part of that intermingling between the GSEs as market players and the GSEs as part of the body politic, which is problematic. I think more importantly to the GSEs, in my mind, were the increased reliance on automated underwriting models, okay, automated valuation models, and I think that was the bigger impetus, which drove the market downward, right? And you got to remember the GSEs, even in terms of liquidity, we can say that yes, a large part of the purchase side was Alt-A. That's absolutely true, and that was reductions in underwriting standards or expanding the box on the software side, and their purchase of PLS. But you got to remember that when a 10,000-pound gorilla comes in and says, "I'm going to buy 25% of this market," it tells the non-smart money, the investment-grade required charter investors, the water is safe, and they followed it in. And so I think the GSEs, as they were, are culpable in a number of ways. I think the goals were really about Congress putting their hooks into the GSEs and the GSEs saying this gives us cover to do.
Remember, the GSEs were being responsive to the mandates of FHFA at the time. They encouraged the purchase of the private label securities.
To a fail?
Or whenever it changed, 405 was...
They allowed
was
PLS to count toward the goals.
And they allowed PLS to count toward the goals. But they also encouraged the purchase. There were also threats to capping their retained loan portfolio during that period of time. They were directed toward that sort of action.
We're not arguing about. I'm not arguing with you about the management of the GSEs versus the GSEs. And so it was this interconnectedness of the body politic.
I agree with you entirely in terms of the mixing of the public and private goals. That's right.
So let's take a break here and see if we have any questions from the audience, if anybody wants to jump in. There's the mic.
Josh, I don't think you mentioned, the mic's not working. I'll talk loud. I don't think you mentioned any potential impact of regulators on the buy side. So one thing that I always thought was kind of strange was a European bank would buy any piece of paper as long as it said AAA without noticing why is it 150 or 200 basis points wider than the U.S. Treasury. And they seem to have bought a lot of stuff. So
Absolutely.
I'm curious to know how you view that impact.
Well, how I view what caused that, or?
How material was that impact?
Oh, it's huge. It's funny. So I'll show you just because it's kind of funny. Hopefully some of you can see it. So this is the yield of AAA-rated securities by type back in 2007. Okay? These are all AAA. U.S. munis were yielding about 3.5%, and you had 39% on CDOs. AAA. Okay? If you go back and you look, same period, at the number of AAA-rated securities by type, those are sovereigns. You had less than 50. Okay? RMBS, you had almost 9,000. And CDOs, you had about 7,500. So, when you allow the rating agencies not to have a AAA mean a AAA across collateral asset classes, you're creating incentives for a grabbing for yield, which absolutely you're right. Which is why when I predicted the breakdown in the system, it was because you no longer had buyers, the smart money, the non-charter constrained, I guess is the more fair way of putting it, willing to buy the equity or the mezz that were put in CDOs. And you couldn't sell the securities without first selling the equity tranche. And so once you had an end to the bid by the non-charter constrained, all of a sudden the charter constrained who were grabbing for yield no longer had securities they could purchase, but they also then had to recognize that the securities they purchased were full of things, rules, standards, and collateral that were other than what they were able to do the analysis and find. And even in terms of the level of analysis, ironically, the amount of information that you were given as an investor varied, which is absurd, based on where you were in the tranching. Okay? And it seems to me that what we really should have had is transparency, so I could actually look at the collateral, have standards, and say, you know what, with this full information at my hand, I don't want to buy the AAA because the yield should be much higher. I should be buying the mezz or the equity if I'm comfortable with the collateral. Right? But yes, I think that had a huge piece of it, and it was the banks and insurance companies purchasing these AAAs that exacerbated the crisis.
Jim.
This is open to any of you. There's a mantra in this town you hear constantly repeated that government is bad at pricing risk. And yet it appears from this crisis that the private markets were pretty bad at pricing risk as well, maybe even worse than the government. I wonder if just let you comment on that.
Well, I don't think any of the pricing models were that great. And many of these are proprietary. The only way I got access to that is through the litigation in various cases. But I do believe, from what I understand of some of the Freddie and Fannie models, and part of the reason why they did pull out of the market in 2003, 2004, was they just didn't feel that their pricing models were telling them that it was really, they could compete during that period of time. That was also the time when the huge refi boom ended, so many of these were the new issues after that.
Let's move beyond pricing models, though, for a second, because I think that what we put into our expectation of the effectiveness or efficiency of pricing models was somewhat absurd. Right? If you were to tell me that I am going to make a loan to someone who I've got no employment history of, no meaningful income history of, he's got non-traditional credit, in other words, he was able to qualify because he was capable of showing me that he had made his gas payments for a period, I would say, I don't know how the hell to price that guy. And logically, no one could price that guy. But we created models that justified the pricing rather than common sense of we can't price. And so I think in some broader sense, the whole crisis could be defined as when models failed. But more than that, it's the behavioral reality that we put faith in models and don't even back check with common sense.
Well, I mean, but that guy works out, the guy you just mentioned, so your hypothetical borrower, he works out fine.
Depending on the product he
takes. You put in home price appreciation,
and depending on
any
the product
works
That's
out,
right?
right? And I would just say, as a government economist, I should say, it's not a failure of government economists that the government doesn't price well. It's all political economy. Obviously, we could generate pricing models as well as anybody, but we don't have what the private sector has that the government doesn't have is people telling you to price at zero, which a lot of our insurance products do.
And that's, by the way, part of the problem right now on the other side, Jim.
And
Of course, they have to
government
be
economists should
priced
paid more.
too, and their models are no better.
Part of the problem on the other side right now is we've got the Fed functionally in charge of pricing, okay? And they are underpricing relative to risk, and therefore we're not able to get private capital in because private capital is saying, you know what, I need a higher yield than that. I need something better than what the Fed is willing to offer, and the Fed is subsidizing the market. And so we have to recognize going forward, rates are going to have to go up. Okay? And we can have the market price a 30-year fixed-rate mortgage with a prepayment and without a prepayment penalty, okay, without government support. If those are products that we want and that investors and borrowers want, they will get priced. They'll be at much higher levels. We have to accept that the right way to deliver social policy may not be through indirect subsidization through financial players.
Any other questions? Maybe in the back?
You touched upon. Wait for the microphone and please identify yourself. Margaret Chadbourne with Reuters. We touched upon pricing of risk, affordable housing goals when we're looking at the housing boom and bust retrospectively. Can you talk about these CEOs at Fannie and Freddie who were basically charged with massaging earnings to increase their bonuses, and how much should we pay attention to that aspect when I said looking back retrospectively at the crisis?
Before Josh takes the bait, can I
There's a T right here with a bowl lofted right on it for you, Josh.
I come here not to bury Fannie and Freddie.
So one thing I'll just, if I could just preface the answer by just saying, I think it's helpful to, rather than focusing on individuals and individual institutions, to focus on the broad incentives that got us here, because that's essentially, as policymakers, what we can fix. So I just preface the answer, and then I'm going to just move my chair back.
Actually, to be frank, not Frank Raines, to be frank, I actually agree. I think that we gave entities that we called private the right to grow themselves with a public benefit, a public mission, and a series of subsidies. And that created an enormous misalignment of incentives, which gave them an incentive to fuel their growth. And we saw that as they moved from really being an originate to distribute to building their portfolios in the late 90s and focusing on earnings. And, it's not worth sitting here and going through the OFAO report and study on Fannie and Freddie and the accounting scandals. That's clear history, but I think to focus on the individuals in that way from a public policy perspective doesn't really serve us going forward and trying to recognize what happened versus what we want in the future. And so I'm actually not taking that bait.
But could I just make a comment, since CDOs have come up several times here? It relates to the whole general question of just how exotic are we going to allow our instruments to be, that there's a certain point of opaqueness or lack of transparency or lack of ability to really analyze the underlying risk, that it's not worth it. The amount of risk, the amount of spread that would have to be added is not worth the additional bump in some way. And CDOs clearly got into that level. I mean, there was no way, they had no information with respect to the underlying issues, or certainly inadequate information on the underlying issues. That was true also with some of the more exotic, the exotic loans themselves, just in the original securities for the Alt-A product and the pay option arm and so forth. But it's not true, in my view, that means that risk-based pricing is out and that we will evolve, continue to permit several alternative versions of mortgage credit out there. There will not just be the 30-year fixed rate or the 15-year fixed rate, depending on what you determine is the likely outcome. That ARMs still have value as long as they're not teased too much and with too many caps and floors and everything else built in that. Also, I believe the risk-based pricing is appropriate from the standpoint of what we called subprime. I believe the expansion of underwriting guidelines, there's nothing wrong, and I don't like to use this term because it casts negative aspersions on this sector of the market, the junk bond market. I mean, what Milken created really has persisted, and it's allowed smaller firms without a credit history to really get access to credit that they ordinarily could not get, and cheaper credit, and it's worked in some cases. Do you expect higher default rates under those circumstances? You bet you do. And that same sort of thing will occur here. So I believe the subprime market does have something in the future, but it's not going to have the sort of opaqueness. It's going to have the transparency that Josh is advocating. This is exactly the circumstance.
With that transparency, I would actually just disagree with one point, which is if you were able to have investors, minus the identifier, look at the loan level information on mortgages in a mortgage-backed security, and those ended up mapped to the CDO by collateral, you would end up with the transparency where people can do the analysis. That's what I do. Okay? I think the bigger problem than CDOs per se is the number of tranches. And so I think we could, if we limited the CDO to, let's say, three tranches, it would work if you had the ability to
But it depends upon the underlying composition. If you're building that up with B pieces and automobile.
As long as I'm able to map from the mortgage-backed pool, the collateral, to the tranche in the mortgage-backed pool, to the CDO, I can do all the analysis.
Well, supposedly that's being done, and that was part of the problem.
It's not being done at all.
The rating agencies had the ability, the insurers had the ability.
They did.
I know they did.
The rating agencies didn't look at loan-level information ever and still don't.
They did. They have access to all that information.
This is what I do.
The insurers have access to that information. It's in the transcripts. Okay.
Now they do.
We'll agree to disagree on that last point. I think we have time for one more, or is that?
We can take one more question. It's a quick question, quick answer.
Okay. Up front.
Yeah, quick question. You guys mentioned liar loans, but you really didn't talk about the role of fraud. I think that's critically important.
Absolutely.
Remember, I'm with GAO. We looked at a lot of this. I can't go into all the findings, but what we said publicly was there were a lot of liar loans, all-day loans. No doc, low doc, increased significantly from 02 to 06. I forget what Fitch reported publicly on this. They said it went from like 2% to like 80% in California.
In late 04 or 05, the FBI came out with their...
Anyway, the point is they skyrocketed like crazy. At the same time, The due diligence contractors, again, we've talked to them, we've read it in the papers. This is all public information, I'm telling you. You know that a lot of due diligence contractors actually found a lot of fraud. But guess what? That somehow all that information never got to investors, never even got to the rating agencies. So even if the models were great, okay, John, as an economist, you know if the data is lousy going in, it's going to be going bad out. So who was responsible for policing these guys? Where was the state government? Where's federal government? Was there anyone there trying to really make sure there really was transparency and truth in investing, so to speak, here? I don't see where it was.
If you
completely
go back,
gone.
If you go back and look, one of the things that I pointed out in this paper in the spring of '07, it's called Misapplication of Ratings in Structured Finance. One of the funny things that you see is the rating agencies had explicit hedge clauses on every one of their documents that said, we have no obligation to verify any information provided to us by anyone, including an issuer. Okay? That was pretty explicitly stated. Okay? So no one was policing it. They weren't self-policing, in my opinion. And there was, even now, in fact, if you go back and you look, Keith Johnson, before the Financial Crisis Inquiry Commission, testified that when he was at Clayton due diligence firm, they had reached out to several of the issuers and disclosed and explicitly highlighted their concerns about the misnaming and less than clear and truthful disclosure about the underlyings. And in fact, I understand one of the rating agencies went and met with one of the due diligence firms met with one of the rating agencies at the very senior level and said to them, you're missing a lot. And in fact, what happened is the customer would say, we know that you're saying that's a 3 in your due diligence report. In other words, it doesn't meet the underwriting standards you define at all, but we want you to relabel it a 2 so that you can put it in because we see mitigating circumstance. You're right. There was nobody policing.
That is the subject of much of the litigation going on right now, and you're going to see a lot of that coming out. It does have to do, and it gets down to the question, first the re-underwriters, if you look at their assessment of this as they went through the third-party underwriters, they found many fewer loans that did not satisfy the underwriting guidelines than now where there are external underwriters being hired by the plaintiffs in many of these cases. They're coming up with non-compliance rates of like 80%, 90%, which we know that there are issues there with respect to a commonality of standards going on. And especially if you look across the different individuals who are doing this underwriting, supposedly with a random set of loans, when you see huge variations in terms of the way they rate this. So there's no reliability, there's no validity in any of that. I guess the short answer is we don't know yet because we're still in the discovery phase.
It is a good lesson for going to the future and creating a new securitization model.
But transparency is the best watchdog.
And some standards.
That's right. And that's the thing I think it's really important to remember. We really still don't have, and we won't have, a private label market until there are standards set.
Well, and I think that tees us up well for the next panel.
Please join me in a round of applause for an outstanding panel.